Welcome back, everybody. Today is Sunday, and you know what that means. We're going to be talking about what in the world is going on with the U.S. economy. I'm going to be giving you some of the stocks that I'm watching this week. And finally, wait for it, we're going to be talking about what stocks I bought this week for my long-term portfolio. If you don't know me, hi, I'm Greg. I spend a third of my time talking about how the US economy is going to sink some more, 1/3 of my time trading options, and another 2/3 of my time telling you to like this video, subscribe, hit the bell so you're notified every single time that I post a video. So let's get into why I think that the US economy has not hit the bottom yet. I started saying this as soon as the market started to rally a few weeks ago. And to show you why I think this, let's turn the clock back to 2018. If you're not familiar with the term, a black swan is an unexpected event that causes a very negative impact on the economy. The crash we saw in 2018 was actually a combination of many black swans. This included the big tech companies doing some pretty shady stuff, inflated earnings, tax cuts, and the Fed raising interest rates. This dip started in October of 2018, when we saw the Fed increase interest rates. So let's fast forward back to now. Earlier this year in March, we saw the Fed decrease interest rates down to 0. And there's been talks about going negative with the Fed's interest rates. What I want you to get from this is whenever the Fed changes their interest rates, they're changing their economic strategy. And this in turn creates uncertainty, makes people freak out, and creates a lot of stock market volatility. Unlike 2018, the recession that we're seeing now was caused by one single giant black swan, which is the C word, COVID-19. Last week, we saw the stock market drop a little more, and this could be due to two different reasons. Speculations about remdesivir not being an effective treatment for COVID-19, which is a topic I covered in this video here, or it could be just Jay Powell's money machine not printing fast enough. Regardless, we're all still stuck at home with nothing better to do than watch the news, Tiger King, and play in the stock market. And this inherently means that consumer spending is down significantly. And the longer that we stay in quarantine, the harder that this recession will be to get out of. Now, my personal economic theory was that this entire bull market for the last 12 years, which is one of the longest bull runs that we have seen in history, was entirely built on credit as well as consumer spending. Essentially, what this means is that companies have been using borrowed money to innovate and create better products, instead of putting their cash into stable assets. A lot of these companies are over-leveraged, and they don't have a lot of cash flow since consumer spending has gone down. So the government's brilliant response to this was sending $1,200 to every individual in hopes that they would be spending this money to keep the economy afloat. When the reality of this situation is that this $1,200 isn't even enough to pay half the rent in cities like New York, as well as Los Angeles, where a large fraction of our population live. But good old Jay Powell is committed to not letting this economy crash. His money printing machines are literally working overtime right now, working 28 hours a day, 9 days a week. And many of you have probably heard of the PPP loan, EIDL, ABC, DEF, XYZ, which are all loans meant to help businesses stay afloat. But like the good old saying goes, nothing is free in life except for my YouTube channel, and companies will have to pay back this money eventually. So in conclusion, businesses are over-leveraged, people don't have money to spend, and there's still no treatment or vaccine for this virus. This is exactly why I think the economy will still continue to go down. Now that we've covered the overall stock market and what I think is going to happen, let's talk about what you came here for, what stocks to watch this week. That's probably one of the cringiest things that I've ever done in my life. First, let's talk about one of the companies that's been hit hardest by this recession. Big old Boeing. Boeing will be holding its annual shareholder meeting on Monday, and this is coming 2 days before their earnings, which is coming out on Wednesday. And this is pretty atypical. Usually we see earnings before we see a shareholder meeting. Nobody really knows what's going to happen during the shareholder meeting, but I speculate that they're going to be strategizing and giving their guidance for this next quarter. Some investors are saying that words matter more than numbers right now, and we all know that Boeing's numbers are going to be trash. Their only saving grace right now is their guidance that comes out during the shareholder meeting as well as the earnings report. Many companies have declined to give guidance this quarter, but I think that if Boeing doesn't give good guidance, their stock will tank. Now, before I give you my plan of attack for Boeing, let me talk about one other stock, which is everybody's favorite, Tesla. There are reports saying that Tesla is calling back some of its workers to their Fremont, California factory, which was shut down on March 24th. Obviously, we all know that they won't be working in full force, but seeing them go back to business is likely some good publicity. And I'm thinking that their stock price is going to Mars this week. I want to show you my trading strategy this week regarding Boeing, Tesla, as well as 8 other companies. So with all that said, guys, let's get into the trades. Here's my weekly watch list for the week of April 26th. We already talked about Boeing as well as Tesla, and these are the other 8 stocks that I'm watching this week. I'm watching the S&P 500, I'm watching Microsoft, Apple, Facebook, Verizon, American Express, Amazon, and Google. Let's start with the S&P 500. There are a lot of earnings reports coming out this week from the major tech companies. Microsoft, Apple, Facebook, Amazon, and Google are all releasing their earnings report this week, which means that the stock market is going to be super volatile. We all know that when the stock market is super volatile, typically this means that the stock market goes down. We saw this high on Thursday of 283. We're very close to this high, so we might see this fall off. Given this, I'm very bearish for the overall stock market this week, and placing a put on this is probably my best bet. We already talked about Boeing and that it's hosting its annual shareholder meeting on Monday right before earnings, which is coming out on Wednesday. Given the uncertainty about the situation that they're in, implied volatility has already gone up a lot for Boeing options. Likely if implied volatility comes down tomorrow, I might buy a straddle and sell before the earnings hits. That way I'm not clapped by implied volatility. The straddle strategy can be used if you're unsure about which way a stock will be going, but you know that it's going to make a big move in either direction. So this is where you buy a put and a call for around the same price, and you might lose 30 to 50% on one of these contracts, but the opposite contract will likely gain 100 to 300%, mitigating your losses for the other option contract. Now, we already talked about Tesla as well. There were reports that Tesla is reopening their factory in Fremont, California, and obviously I can't afford anything close to the money with Tesla options. The great thing about options trading is that there are a lot of options when it comes to options contracts. Since I can't afford an $8,000 to $9,000 option, I might place a call debit spread close to the $750 strike price to make these options cheaper, as well as limiting my risk. I personally own shares of Microsoft for the long term. I'm thinking that they have a 50-50 share between consumer products and the services that they offer, and we all know that consumer spending is down right now, especially in the tech sector. So given this, I really don't know which way they'll be going, but I do think that they're going to see a huge move in earnings. Buying a straddle before earnings for Microsoft would likely be in my best interest. Now let's talk about Apple. Apple relies heavily on consumer spending. Although they have started to make movies and TV shows for Apple TV, this might help them a little bit to keep them afloat during quarantine, but it might be too little and too late. I'm thinking about placing a put for Apple. Now, Facebook. Facebook is probably going to see a move similar to what we saw from Snapchat. They rely heavily on ads just like Snapchat does, and Snapchat saw a huge 20% run after they released their earnings. They're also expanding the services that they offer with gaming as well as possibly the Libra coin. I'm thinking that Facebook is going to go up, and I'm likely to buy a call for Facebook this week. Let's talk about Verizon. Obviously, Verizon has seen a lot of usage over the last 2 months with everybody stuck at home. Everybody is streaming movies right now. Everybody is watching YouTube. So they actually already had their earnings call. The implied volatility for Verizon has likely dropped, but they might continue to see a surge in usage, and we could see this continue to trend up above this exponential moving average line on the 6-month chart. So I might buy a longer term call for Verizon. American Express also had their earnings call on April 24th. They're continuing to trend down below this exponential moving average line, so likely they'll see a run up to this exponential moving average line and get rejected again. I believe that there is going to be a credit crisis, and I've been talking about this in previous videos, and American Express relies heavily on credit cards and consumer spending. I might place a long-term put against American Express. Amazon has obviously been doing well, reaching all-time highs here at $24.61 during this pandemic. They're working their butts off to fill the demand that they've seen over the last 2 months, and given the nature of their business, being an online retailer, when all the storefronts are closed, they are doing very well. But the issue with Amazon is that they are highly overvalued. When we're looking at the RSI, it went all the way to 88, which is insane. People are likely expecting earnings to be really good for Amazon considering how overvalued they are. If they don't perform as well as expected, they'll likely drop down to the exponential moving average line here at 22.15.85. And again, I can't afford Amazon options outright, so I might buy a put debit spread on Amazon this week. Now finally, Google. Google hasn't been doing quite as well as the other tech companies, surprisingly. They offer a lot of online services, and their AdSense should be through the roof right now. They're having their earnings call on April 28th. I'm thinking that they will raise to about the midpoint between the high and the low that we saw. I will likely buy a call debit spread on Google. That is my watch list for the week. Now finally, let's get into the last part of this video. What stocks I bought this week for my long-term portfolio. First, I bought 2 shares of SDY, which is an S&P 500 dividend ETF. I've gone into depth about the stock in a previous video. I bought 2 shares of this at $82.90. $1.98. And the second purchase that I made for my long-term portfolio is one share of Qualcomm, and I bought this for $72.71. Their ticker symbol is QCOM, and looking at their 5-year chart, they're only up about 12.8%. The reason why I saw value in this company though is because they are one of the leaders for 5G. And given the new internet age that we are entering, I think that 5G will play a huge role, and Qualcomm is one of the big 5G companies. That is the end of today's video, guys. Thanks for tuning in. Remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.